Let's get a check on how earnings season is faring more broadly so far and how markets are reacting. We'll bring in Dan Suzuki, Deputy Chief Investment Officer at Richard Bernstein Advisors, joins us here on set. Dan, I guess set us up here. Obviously, we had a market that many people would have said, had a pretty aggressive start to the year in terms of stretching to the upside, maybe needed a correction. We have obviously these fears of coronavirus coming at a time when baked into markets was an expectation of a global cyclical rebound in the economy. So where does that leave us with these new doubts?
Yeah, I think that in the near term, it puts a little bit more uncertainty on the story. I think that, anytime there's a big difference between when unexpected things happen early in a cycle versus late in a cycle. Early in a cycle, things are cheap and there's a lot of good things happening to offset it. It can look through that. Later in a cycle, when valuations are higher, I think it just tends to add a lot more uncertainty and volatility to the market. So I think that's something that people need to keep in mind. Obviously it's going to, knock the stuffing out of near-term growth, particularly in China. But as you look through, I think that, the question is a year from now, especially given probably the stimulus you'll have there to offset it, are things going to be looking better or worse? And I think that, you could make the argument that things are better a year from now with China and the stimulus going on there. But I think, that when you look at the underlying fundamentals, though, I think it's safe to say, I always come on the show and Joe always gives me a hard time for being, kind of bearish.
I can do that if you want. Going in, but
the reason I sound bearish is because we're always looking at perception versus reality. Markets always focus on perception, which drives the near term, but we're focused on reality. And when there's a disconnect, I'm trying to point out where things are a little bit worse. So there's been this perception for the last 6 months that things are amazing, and I would say that, if you look at the underlying fundamentals, and we can bring in Steve and kind of have this economic debate, that things we're showing a lot more signs of slowness and weakness, even still. And I think that right now we're just at this weak point where things could be starting to turn around. You're seeing more of those signals outside the U.S., and then you get the hit to the biggest engine of global growth.
Well, I keep saying, 2% growth last summer when we were worried about a recession sounds pretty good. With the stock market up 10% in the U.S., 2% is okay, maybe not necessarily so great. However, you at your firm have been defensive with regard to U.S. shares, but you have been betting on China. So suggesting from what you said, you're not changing that view that China actually looks like a good
That's
value.
correct. Again, and we're not event-driven, so that we're not going to react. Like a lot of people, what they'll do is when something like this happens, they'll sell with the hope of getting in at the right moment. I've yet to meet someone that actually does that does that timing around those trades consistently and outperform. So I think what we're doing is focus on that longer-term story. And again, next couple quarters going to look bad from a profits perspective. It's going to look bad from an economic perspective. But with the stimulus that they're going to have, as the infectious rate falls, as things get warmer, hopefully, things will actually look much better. So we're actually sticking to our China call. At some point, if this continues to weigh on markets, it might be a positive entry point. But then we're looking all around the world. I think most of our moves recently have been to shift and move a diversification regionally outside the U.S., where things are looking a little bit better and they're cheaper, so you're getting paid more.
Dan, you don't have any concerns about the buy right now on China? I mean, just not knowing what we don't know in terms of this virus.
Not even knowing the price, because the market's been closed.
Right, and will continue to be closed for a while.
Well, I think that obviously there's a level of uncertainty when it comes to with something like this, and no one knows, and I don't claim to be an immunologist or epidemiologist, which is why, we're not trading on these things.
But even not knowing what's going to happen with the infection at this point, just looking at the massive lockdown of people, the massive shutdown of factories, of workplaces, of anything else that happens there, China's trying to do their best to contain this. Those containment measures are going to be very expensive in the short term. Somebody pointed out before, we've never seen a lockdown of human life on this scale.
Yeah, absolutely. So in the near term, that's going to weigh on on China and global GDP. It's going to weigh on trade. It's going to weigh on profit. So I think that's going to be a big negative.
You be a buyer the day it opens, or you wait and see?
Well, listen, we're actually owning China through the a lot of our positions are through the ETF. So the ETFs are trading here in the U.S. So you've seen it show up in the ETFs. They've been down, and I think that that's a normal reaction to be expected. But the question is, when you get that leg down, should you buy or should you sell that dip? And I think tend to be more of a buyer, given that everybody's focused on this without actually knowing the outcome, and so a lot of that negativity is priced in. And again, name a widespread virus. I mean, everybody looks at the SARS example. Look at all these historical examples when that hasn't been a buying opportunity for someone with a bit of a longer time horizon.
Yeah, well, sometimes after a pullback, but a little deeper one. But we'll see how that goes. Dan, thank you.
Thank you.